I'm going to go ahead and start. It's not like tonight's speaker needs a lot of introduction. I want to say one thing about Glenn Greenberg, because we haven't obviously been here since then. And I think it's an important point, actually, of technique. The reason I'm going to say one thing is that I just had lunch with a very successful ex-student from Harvard Business School who said he learned exactly one thing in each course. And I thought if we could do better than that and have you learn one thing from each speaker, we would be 12 times as effective as Harvard Business School. What I hope you know, what he has is, of course, an extraordinarily concentrated portfolio. He talks about 10 to 15 positions. He has, for long periods of time, had as few as 5 to 7 positions. So he does very concentrated holdings. When you do that kind of investing, you better understand immediately and thoroughly what the critical issues are that are going to determine the value of that investment. And notice that's what he focused on. He focused on identifying the 2 to 3 things that were absolutely going to make or break that investment. And if you don't know that, you're treading in very dangerous territory. Now, the last piece of that puzzle is that you'll notice when he does the valuation, he is not a big model guy. That what he wants is a very simple model, a very simple view of how it is this firm is going to make money and what value that's going to generate. Now, that is absolutely essential if you're going to focus on the few critical issues, which is in turn essential if you're going to run a very concentrated portfolio. So if you want to do concentrated portfolios, you better learn to give up the complexity. And when he got himself in trouble, it was when he did complex models with 8 to 10 variables and did not have a clear sense of which were the crucial influences. So if you want to follow that particular path, of which Glenn is probably the most successful long-term practitioner of a very concentrated portfolio, I would keep those lessons in mind that I hope were evident from his talk. Now, I'm not going to spend a lot of time introducing tonight's speaker. He is one of the great innovators in value investing. He did it so long ago that by now it is a commonplace. The idea of looking at private market values where you can't get a good, tight reproduction value of the assets because there are a lot of intangibles or the earnings power is uncertain, but making sure there's a catalyst so you don't have to live with that private market value for a long time, and also having a good feel for hyping the companies to the catalysts who you hope are going to buy them is in fact an approach to value investing which was developed by our speaker tonight and is probably as important as Buffett's long-term view of buying good franchises and holding them forever, provided you can get them at decent prices. I think he's less well known for that is a lesson that I'm going to tell you about is we were involved in a deal. I, as a professor, wanted to grab all the deal for ourselves. Mario insisted that we give it to the investors. That, too, is an important lesson that he probably won't talk about. But if you're going to do this professionally, rather than just talk about it, you have to be prepared to give it to your investors. With those lessons in mind, Mario, welcome to the class.
Thank you, Bruce, for allowing me to come back here. I know I've met some of you over the years and delighted to say hello to those that I haven't said hello to. The analysts that work for us are simple. I'm one of them. We gather the data, array the data, project it in our style, and then figure out whether we have a margin of safety and buy stocks. We're a public company, and I'll go through this in more detail. I gave you some handouts, so I just want to go over them. One was about 15 years ago, Bruce, you and I and Roger Murray. I don't know. They must have had extras, so they put that in there. I've got a couple of research reports that we did. One on Cadbury. It was written by Kevin Dreyer. Kevin graduated from here about 5 or 6 years ago, and Kevin wrote up something for the Graham in Doddsville. He was interviewed and gave you his thoughts. Read it at your leisure. There's no Yankee game tonight. And Tiger's already finished putting out. You have, in addition to that, Chris Morangi, who graduated about 4 or 5 years ago as well. And then we have samples of how we think about a company. Most analysts would put a 10, 15-page grid together. This is an example of Millicom. Millicom is a company that has 100 million shares, sells at about $90, $9 billion market cap, controlled by a company out of Stockholm. So if you saw the girl with the dragon tattoo, or the woman with the dragon tattoo, it's in Swedish so that you could prepare yourself to go to Stockholm and visit the company. They don't that stuff. Here's my problem. Okay, Bruce. I assumed that Michael, who's had some reasons not to be here, was here last week, and then you had Glenn, you had all these smart guys, and you have learned everything. So I was figuring out I have one problem. And the problem is simple. It's similar to what J-Lo's third husband had on their wedding night. He looked at J-Lo and said, "Look, J-Lo, I know what I'm supposed to do, but how am I going to make it different and interesting for you?" So I have the same challenge. And so I decided to do it my way, and guess what? For an hour and a half, you're stuck. So good luck. Let's see if I get this to work. Now, why do we do this? Why do the individuals and Glenn probably actually plays a guitar, Greenberg, and because we love the markets. We like the intensity, the action, and every day coming in and seeing how stupid we are. So that's why I like it. That's why I do this. Plus, I like Bruce, and I'm absolutely, because of Columbia. I graduated from here in 1966 or 67. So that was, 43 years ago. I went to Fordham. I grew up in the Bronx. So between Wall Street and Greenwich, I've never lived anywhere. So a lot of you guys come from various parts of the world, and you travel everywhere. So I have to figure out, where parts of the world are. So it's interesting. I'm talking about investments in Zimbabwe. I started as a sell-side analyst at a firm called Lowe Brothers, which became part of Shiselov, Lehman, and that's gone. So in any event, they're all gone. So private market value with a catalyst. What does that mean? It means if a company is public and somebody takes it private, it's now private. So you figure out what it's worth. What would a Henry Kravis pay? What would a Carlson Wells pay? What would somebody pay? Or what would a corporate buyer pay? The catalyst is some dynamic that we'll talk about that says, hey, this is evident. The easy catalyst for us to think about, can you hear me in the back? Yeah. Okay, the easy catalyst was simple. Cadbury had a couple of businesses. They spun off Dr. Pepper 7-Up. Nelson Peltz was not nibbling at them saying to do things, and then all of a sudden Mars and Wrigley merged, and it was fairly visible that they had to do something. Another example is a company in Monterrey, Mexico called FEMSA. FEMSA sells beer, Dos Equis, and so on. And they have a business in Mexico with like 8,000 outlets, like 7-Eleven, they call them OXXO, where they sell beer. And then they had a business that they own 50% or 62% of a company called Coke FEMSA. And all of a sudden, you had InBev by the guy in St. Louis, Budweiser. And all of a sudden, we said somebody is going to figure out that FEMSA, with their beer business, is going to have to merge with someone else. And sure enough, so these are kind of simple examples of catalysts. But let's talk about it. And the best way to do it is to bring in the professor that I had here a few years ago, and who could talk about private market value. And this is Roger Murray. This is 15 years ago. Can you hear it?
That I'm going to. In some parts of this world, some not unknown to all of you, there is an expression called private market value. A fascinating I ask myself is, we really want to get Mario to answer this, are we talking about intrinsic value dressed up, given a different label, because it's more appealing to people if I talk about private market value rather than what some people think of as an unreal abstraction called intrinsic value. If I say to myself, how would I define private market value? I would say it's likely to be intrinsic value plus potentially a control premium, because by definition, being private, I can turn over my business in jeans to a private entity, and I can use a longer time horizon than if I've got those ridiculous analysts and shareholders out there giving me a time. So,
Roger had retired probably 3 or 4 or 5 or 6 or 7, 8 years prior to that, and I called him. I said, Roger, listen, we've got to do something. We want you to give 4 lectures for an hour and a half each at the Museum of Television and Radio here in Manhattan on 52nd Street, and we're going to videotape it. And he did, and we have discs of those, and the university has those, and I think Bruce and Mayor Feldberg at the time attended one of those lectures. Roger came over, hour and a half each without notes. Walked from the Yale Club over there in like 0-degree weather with a knapsack and a light jacket, what he has on. So, Bruce, we're going to count on you to do the same thing 40 years from now.
I'll do it in a motorized wheelchair.
Sedgeways. The way we have as a catalyst is simple. You find a stock that has a discount from what we call intrinsic value that somebody would pay up for. And then we want to, basically, we're not in the academic game. We have no tenure. People fire us all the time. And so basically what we want to find is some dynamic that will help surface that value, narrow the spread between the value that we're buying at in the public and what the company could be taken over at, or some form of financial engineering. So examples of catalysts are many, and you can find them all the time. The regulatory change. Right now you've got the Obama administration changing health care. You had Janikowski, who runs the Federal Communications Commission, coming along and offering a 300-page document about what his template is to get spectrum. So when you buy an iPad or an iPod and you have all this spectrum HODs, you need more capacity. Where do you find it? And where's he going to take it from? And what does that mean for an existing company that has spectrum? You have the death of a founder. For example, if Sumner Redstone, let's not go that close. I can't, whatever. If a stock is selling and there's a family block and the kids want out, and the guy dies and they sell it at, the classic example was Walt Disney. When he died, the stock went up 10 points. And so we look at things like that. Obviously, we'd like to be there a little earlier. We used to call them our octogenarian plays, but now it's 110 years, so we call it the centurion plays or something. Repurchase of stock, sale of a division, management of capital. So there's a whole bunch. A classic example occurred in June. This is a big picture catalyst. In June, I hope, was the month of 1989. Tiananmen Square. What was the significance of that? What was the significance of this, which is the Berlin Wall in November of that year? And it basically said, look, capitalism is emerging as the best of all the poor alternatives to allocate capital. What it also meant was that you had 3 billion new consumers coming in the marketplace, China and India. And that is what we're seeing today. 20 years later, we're seeing that benefit of the end of the hockey stick of where consumer is going. So when you hear about the American consumer representing the U.S. economy is 25% of the world's 64 trillion GDP, and the U.S. consumer is 3/4 of that, and the consumer's got all sorts of problems, and the question is that enough to look at? What about China, Russia, India, and Brazil? How much of the cribs in the world, and how big is that consumer, and what kind of an impact is it going to have? So that's what the significance of that was in creating what we all call, Goldman calls it bricks. I can't stand Abby Cohn when she does that, so I created the crib. They were coming out of the crib. You know, I don't want to give Goldman Sachs anything. So, again, that's kind of what we're going to talk about. And the rest of this, you can go to sleep or email me. Bruce invited me on April 1st of 2008, and I said I will not do April Fool's then. So we did it April 2nd, and now we moved it up to April 8th. So, you know, we keep moving along. This is me, and this is my uncle. Essentially, since every one of you have GMATs that are off the charts, and you all went to some smart school, and you think you're bright, some of you are even what I call PhDs, and that's what we hire. We only hire PhDs. Rick Pitino came to us when he was interviewing for a money manager for Jamal Mashburn a few years ago, and he said, how do you find that analyst? How do you find that analyst? And we said they're PhDs, poor, hungry, and driven. One of the gals who grew up in Greenwich, went to Wellesley and went to Columbia, said, privileged, hungry, driven also works. So I don't know which one of you are, but that's Darwin. Basically says fairly simple. Is it the smartest that survive? Is it the most intelligent, or those that can change? How do we adapt to the world? Okay, you entered this school when Lehman went bust. This is exciting. You're coming in at the beginning of a whole new wave. You don't want to come in at the top. Imagine if you got a job from Lehman and started in September. Oh, I gotta feel somebody worked at Lehman. I can feel it in here. Oh, God. That's why you're here. Anyway, another cousin of mine, that concept, how does the iPod create new demand, and what did it destroy? How did Napster and Kazaa destroy an old business model on music? How does the Google change the whole world in which, using digital, and it changed the world for newspapers? And it's what helps in capitalism. Creative destruction. How do we create the new cycle of entrepreneurs that everyone in this room is going to be, or business owners? One of you is going to run a business, one's going to do a conglomerate, one's going to run a hedge fund, one is going to run Goldman Sachs someday, and somebody will get stuck running Columbia. So what are we going to talk about tonight? We're going to tell you who we are in 38 seconds, the world in which we're a part, and which we'll talk about value investing because I have to pay homage to value investing and because I believe in it. And then we're going to talk about 4 stocks. We're going to talk about Cadbury, we're going to talk about Millicom, we're going to talk about National Fuel and Gas, we're going to talk about Ascent Media and DirecTV, so it's 4.5. So who we are, we work for a public company. We went public in 1999 through Merrill Lynch, Smith Barney, and Merrill Lynch is now part of B of A, and Smith Barney is part of Morgan Stanley. And we're still here. Why? We started the firm in 1977. At that time, and I bumped into a guy. I went to the Knicks Celtics game the other night. The guy walks up to me. His name is Andy Murstein. He owns a company called symbol is Taxi. They basically finance all the medallions in New York. It's like $8 stock, 20 million shares. He's got a lot of leverage. In 1977, when I started the firm, a taxi medallion was $35,000. How much do you think it is today? You got it right. $750,000. A seat on the New York was less than that. So that's how interesting the world was. And that was only 32 years ago. So what you hope is that you can get those cycles to come back. And so we started in 1977. The basic concept was simple. Pick stocks, make money for the customer. I was 7'7", had red hair at the time. And, the bear markets beat you up a little bit, such is life. And basically, we want to make an absolute return, look for private market value at a catalyst. And at that time, be tax sensitive. Taxes are probably 30%. They're down to 15%, but they're creeping up at an accelerating rate in terms of capital gain rates. So we have offices today. We do research. We don't follow Chinese companies. We don't because they're Chinese. We follow them because they're in the beverage business. So when you think of Gabelli, you think of a very simple concept. You drink it, we follow it. So if it's Ting Yi or a tea or it's a beer or it's booze or soda or juices, And we have a fellow working for us in Hong Kong and one in Shanghai. And the guy in Shanghai actually was our beverage analyst before he decided to do something else. And then he came back and he graduated from Columbia probably about 10 or 12 years ago. And then we have an office in London and a couple others. And we cover industries. So Chris Morangi, who graduated from here, does our digital work. Kevin Dreyer does health and wellness, and he drinks a lot. So he covers the beverages. He got a team reporting. That's how we're structured. Now we are in essentially the judgment business with service organizations, and the judgment is used by separate institutional accounts, long only. We have 1,700 of them, each separately managed. It's about $12 billion, all equities. 1,600. I guess we lost 100. We have 30 mutual funds. And then we have hedge funds. We've been in the hedge fund business longer than mutual funds. The day I left Columbia, I joined Low Broads. The day a name that's gone, Low Broads had a fellow on a Friday night by the name of Michael Steinhardt who quit. Michael Steinhardt started one of the most successful hedge funds, Steinhardt, Berkowitz, and Fine. They were one of the few that had an up year in 1973. He retired in 1994. He didn't sell it out or anything like that. So I inherited his industries, and his industries included the farm equipment, conglomerates, auto parts, and blah, blah. And that's what I had. So I started hedge funds in 1983 or 4 before mutual funds. So that's us. Mutual funds, hedge funds, private wealth management. And this guy here was our largest shareholder, owns a convertible in our company, and he doesn't even know that we exist. Now he does, actually. The deal was a handshake, and he said, okay, do it. That's what he looked like. So they get turned off by the way people look. Some may look like me. Some of them, these guys are all billionaires, such is life. And isn't that your boss? Which one is Paul Allen? Right here, right? I got to tell you, I get confused sometimes. So when you think of us, you think of value. What does that mean? How do we add juice to the table? How do we bring and earn a return by looking stock specific, one at a time, and building value and structuring portfolios that way? And at any time, whether it was 1973, 1999, probably 08, value looks dull and boring. And that's what we are. And this is what we did in 32 years of running long only. So we had 5 down years. The worst year for us was the fourth quarter of 08. And one of the better years was 09. We have a 16.8% CAGR, long only, diversified, tax sensitive, and institutionally appropriate, and everyone thinks we're dull and boring. And that's our benchmark is 10% real plus the S&P. Put it another way, if you started with $5 million invested us, today, if you left it in, it would be $752 million. If you put it in a mindless index like an S&P, you did quite well. You had $154 million. But the way we look at it is the alpha was, somebody figure it out. That's the alpha, the difference. So then if you did it over the last 10 years when the markets did nothing, you lost money in the S&P and you made money with us. I wish I had 10 million when I started. I wouldn't have to be here tonight. Our value culture. So what is it? I was in this classroom in 1965-6, right? And we're trying to figure out, so like some of you, what do you do when you graduate? What should I do? So we had, very fortunate in my case, we had a movie called The Graduate. At the time it was very steamy. And it was Dustin Hoffman and Anne Bancroft, and it was called The Graduate. And, I have to be, are we videotaping? Anyway, some of you remember the sexy scenes in the movie, and that was then. Imagine what the world's changed.
We are so proud. Proud. What are you going to do now?
I was going to go upstairs for a minute.
Oh, I meant with your future. Your life.
Well, that's a little hard to say.
Ben.
Excuse me. Mr. McGuire.
Ben.
Mr. McGuire.
Kind of different name. I want to talk to you. Excuse us, Jim. Thanks. I just want to say one word to you. Just one word.
Yes, sir.
Are you listening?
Yes, sir.
Plastics.
Exactly. How do you mean?
There's a great future in plastics. Think about it.
Now, some of you that saw the movie realized that what Dustin Hoffman was thinking was that when the old guy took him outside, he was going to have a little more dynamic a confrontation. So what do we do next? Chad Hurley? Who's going to invent YouTube 2? Who's going to come up with alternative energy? Who's going to consolidate an industry? So what do you want to do? Do you want to go work for the next Goldman Sachs? Do you want to do it in Hong Kong, Dubai? So here's today's version of a movie.
I just want to say one thing to you. Just one concept.
Yes, sir.
Are you listening?
Yes, sir. I am.
Graham and Dodd.
So with that as a Rosetta Stone to unlock value, your career is open-ended because you're gathering data, gathering knowledge, learning all of the dynamics of how to analyze an industry, a company, or any situation. And whether you want to run a business, you want to run money, you want to run an endowment, you're getting Graham and Dodd. 76 years, and nothing's changed. You think of the great institutions over the years, though, whether you start with the Guptas in India, or you go to Egypt or Greece, or you start with various civilizations, they last a long period of time, 300, 400, 500 years. Rome, the United States. So far, Graham and Dodd 75, and Bruce and I are going to keep it going for the next 250 years. So these are the guys. Those are the books. And this is one of the students, Mr. Buffett, where some of us will be in about 2 weeks in Omaha to go and see him because it's kind of fun. Plus, there's 35,000 people that show up that have money. He basically said, look, he was doing okay in 1951. He came in and took a class with Ben Graham, and his life changed. You're a speed reader, so if you don't know it, it's too late. And then, obviously, Roger Murray, who I had in this, wrote a book and an update just before we did that video, and he was teaching it. And then we have this guy who's done a couple. So what we did is that one day I was flying over from Jackson Hole, Wyoming, to somewhere, and I needed gas, so I stopped off at Rapid City, and I said, let me go see this. Okay, this is Mount Rushmore, for those that don't know. Some guy about 80 years ago thought it would be a good idea, and that's the guy in the middle there. So he commissioned someone to create it. So he put the 4 presidents up that he thought were important, including himself, and so it's a tourist attraction. So what we did is we said, Graham and Dodd, Murray and Greenwald. So we now have that, we have that as a prize that we give away each year. We put $1 million in a pot, and Professor Greenwald and his team identify someone either in the academic community or in the professional practitioners who deserve the Graham and Dodd Prize. The first 4 guys were probably billionaires and they haven't cashed the checks yet, and the 5th guy's even worse than that. So those guys are all good money men. You remember this guy? Sully? He landed a plane on the Hudson. Oh, there we go. He showed up, Bruce, as a prize. He landed a plane on the Hudson River. So it's good to have a Graham and Dodd guy at your throttles. Now, what do? We hire, we train, and we have analysts. Because we have analysts, we try to figure out where to have them work. We had a guy go over to Mongolia. No one's been there for a long time from our side, and we sent him to see a mine in Ivanhoe. He's now on his way to Zimbabwe because we think Zimbabwe is a very attractive place to invest. But we like to find what is, but that's kind of just keeping the pipeline full. So the analysts read 10Ks, they read the 8Ks, they read industry trade data, they go to industry conferences, they're gathering the data, they talk to managements, They gather data points and they connect dots. This is an example of one of the guys in Wyoming connecting dots in the Teton Mountains. Another guy doing work at a pool in Monte Carlo, unfocused on some of the surroundings. I think they edited those out, didn't they? Here's another guy looking for big game or small game down in South Georgia. And so the analysts we assign an analyst to follow an industry, stock specific. So every company, whether it is in the beverage industry, we follow it. So he has to go to Paris to visit with Pernod. He's got to go visit Diageo in London. He's got to go visit Campari. He's got to go visit companies around the world. And he has to sample all the products. Indra Nooyi, for example, that runs Pepsi-Cola, had a 2-day meeting at Yankee Stadium to talk about cola and chips. I mean, 2 days. That was about 2 weeks ago. So he had to be there. We like cash-generating franchise businesses, and we can go over that. What is the private market value of each? What is it worth if you could sell the whole company? How much can you make? Can you make 50% in 2 years? How realistic is that? And that's what we do. Now, there's a kind of a word that I happen to like that in the language that's written in says crisis. To some of you don't know, this is Shanghalese. The print is Shanghalese. No, it's not. And it has a double meaning. Crisis, Ouija, and also it means danger and opportunity. Anytime something goes wrong, it's terrific. What and how can we make money? We all have heard about this dynamic. What did we miss when we look at the world and look for that black swan? But look at the reverse of that. A year ago was end of February of 2009. The markets were down 20% on top of the decline in the fourth quarter of 2008. And you had individuals come out and say, those green shoots are turning brown. You had to say to yourself, wait a minute. Reverse it. What are they looking at? Some were looking at this and saying, you missed it, and some were saying, were they? So, what can go right? So we call it our Vision 2010, and I'm not going to go over what's going to happen this year. It's basically, we summarize it in 3 big words. 3 elements that will influence Beijing. What is happening there? B is Bernanke, and how is he going to throttle back before inflation takes hold? How does monetary policy get an escape hatch? And then the other guy, the other B is Barack. And that is, how does he handle the fiscal policy? And we have an election coming up in 5 or 6 months, and what happens if the conservatives win or the liberals win? What kind of policy will they have? What will the market look like for 2011? And how's the economy and how's the market going to respond to that? So we think about all of that. We could go over that, but that's not important for today. And then we think about what's going to happen in 10 years. If the market grows at 5 to 7%, that is an S&P index due to gross world product, margin being maintained, asset turnover being maintained, and multiples contracting because interest rates going up, what level would the Dow be? So if you watch these turkeys on Squawk Box like this morning, that was me, you would see that they're asking what's going to happen next week. Well, if you sit back and say, okay, the market did nothing for the last 10 years, so if you bought an S&P index and did mindless investing for the last 10 years, you didn't make any money. How much can you make if you put that money to work in the next 10 years? Is the Yale model working, or is the Harvard model working, or is none of those models working, and what should we do differently? And what does all that mean? To help you put that in perspective, we kind of took asset classes and looked at them, and I don't know if you can see this, but essentially, if you took stocks, bonds, bills, and inflation, and you said, okay, since 1926, that's about 84 years, and it's Ibbetson's numbers. By decade, you lost money in the 30s. If you had an index fund, you lost money in the last 10 years. And what are you going to do in the 10s? We're saying, put in quotes, and I Bill Gross and I have fun over this. What's the new normal? I said, Bill, that's bullshit. That's what we've been doing for 100 years. And I think you make a compelling case of making 5%. If inflation goes up somewhere down the road, what will bonds and bills return you? And you could drop in your own models. We as a firm, and because of our impact on research looking for nuggets, we think we'd add 500 basis points on that unleveraged, diversified, and that's not in our hedge funds. The hedge funds will do something totally different. Again, another slice of the same data. If you and I were in this classroom in 1977 when I started a firm, the total amount of all debt in the world, fixed income market in which we can buy and sell, was $2.1 trillion. At the end of 2009, it's $66 trillion. So if you're doing fixed income, that's a big number. Again, at the end of 2000, it was that, and that's what it's done. I don't know whether that's good or bad, but it is the numbers. In the equity markets, it was $1.6 trillion when we started. At the end of 2009, it was $45.8 trillion. So let's look at that, because the wealth effect on the global economy has had an impact on consumption. At the end of 1999, 10 years ago, you had a technology, media, and telecom bubble, and the market was $30 trillion on a global basis, all stocks marked to market. It dropped at the end of 2002 to $22.9 trillion. So Greenspan lowered interest rates. He had to cushion the impact on the economy of that decline, and that created another bubble. The market then got up by the end of 2007 when private equity guys were going around and saying, hey, we've got an efficient capital structure model. What are you talking about? You don't want to do 8 times EBITDA leverage? Or leverage to have EBITDA to total enterprise value. And everybody hyped things up, and the economy started turning south probably fourth quarter of probably October, November of 2007. It got to $61 trillion. It collapsed at the end of 2008, and by the end of February of last year, it's probably down to about 25 or 26 trillion. That's a pretty big mark to market. And if you had stocks and you had a house, you felt even more challenged, particularly if you were on margin. So we're back up to 45 trillion. Probably right now you're probably close to the 60, and housing prices are still down, but having an impact on consumer outlook. I'm not going to spend a lot of time on this because I want to get to stocks. The issues are China, Russia, and Brazil, a whole bunch of issues. Will they be strong enough to offset the weakness elsewhere? Balance sheets are terrific. You read annual reports. Deals are, we call it corporate Cupid. We're seeing a lot more deal activity. You've had 5 cycles of deals over the last 70 years. We're in our 5th cycle. That's important to us. That's the catalyst. Companies feel more confident. They have a good balance sheet. They're trying to make acquisitions. What do they want to buy? Where do they want to buy them? Or companies want to buy in minorities. They want to spin off companies. A spin-off is a simple example. A year ago, Bristol Myers decided they want to get rid of their baby food business. They spun off a company called Mead Johnson, Pediatric Nutrition. The stock came public at 24. We followed it. Enfamil. And the stock's today $52, 200 million shares, 10 billion market cap. It's got great brands, more spend per child. Who's going to buy it? Financial engineering. Pepsi-Cola decides to buy in their bottlers. Coca-Cola follows suit and takes in Coca-Cola Enterprises. Alcon is owned by Novartis. They want to buy in the minority interest. There's a deal a day to buy in a minority interest somewhere in the world. In addition to that, companies are doing transactions. The other day, a company called CKE, which was being bought by a private equity, had another private equity firm overbid it. So you're seeing all those types of transactions, and that gives you a benchmark as to whether your private market value multiple is valid. It also gives you a benchmark that what happens in an industry. An easy example of that was a company called Valmont located in Omaha, Nebraska, which we're going to be visiting in 2 weeks. They sell irrigation equipment. So Valmont decides to buy a company called Delta in the UK. Stock was selling at X. They paid 50% above X. And we said, whoa, why are they doing that? What's so interesting about galvanizing? It's not a particularly interesting business, but it's an interesting cash flow. So we immediately wrote a report on it. Zahid Sadiq, who works with us, who graduated from here about X number of years ago, wrote a report, and we focused on North American galvanizing. Within a week and a half, another company called AZZ bought it. So it's you get a sense of focusing and creating dynamics in an industry by following those kinds of... So that's corporate Cupid. And, you know, obviously we can talk about jobs, oil, dollar, inflation, blah, blah. And we could talk about the Hezbollah of the default business, the credit default swaps. And you got to say, you know, CDSs, were they a dynamic? Was it Wall Street with their financial engineering? Was it a salesperson that sold, you know, somebody with $200 million to generate a commission? When they packaged this stuff, were they doing what was morally right, or were they just doing because they had to sell a product and there was a financial innovation and it was going to help the world? Well, now we have a new generation of these. TARP 1, 2, 3, PPF, TALFs, ZERPs, and a whole bunch of others. Guess what? They're all going out. What and how do we allow the world to have financial innovation and yet allow the world to be constrained with products that people understand and understand risk, and so they're not packaging crap and selling it out and trying to make $1 or $2? It's an interesting time. One of the things that's popular today is talking about healthcare. So we've been doing health and wellness for a long time, and I just wanted to show you how we think about a few things before I get into stocks. If you look at the world population, in the year 2000 it was 6 billion. By the year 2050 it'll be about 9.4 billion, which is less than 1% growth, unless H1N1 takes advantage. You know, something will happen to slow it down, but let's assume these are the numbers that somebody pencils in. Those from 0 to 4 years old stay reasonably constant. So if you're selling pediatric nutrition like Enfamil, or you're selling diapers, how do you grow? Is it more spend per child? What economies are going to do that, and how will you get globally positioned? The reason we have 8-foot basketball players is that the Enfamil that they get now has probiotics to engineer 7-foot or 8-foot basketball players. That, as you know, is theory A, and that's bullshit. Because otherwise, each of us would take little probiotics from Enfamil and create individuals that get 800 on their GMATs and start off in life with $1 zillion. But anyway, that's what we look at. But the real growth is the population over 80 years, and what do they need? I want you to take one idea out of here, and what they'll all need are diapers. Anyway, the U.S. population is growing. The healthcare as a percentage of GDP was up to about 17%, and it's continuing to grow. Something had to give. You can't do it. Was Obama right in pushing this as opposed to jobs, creating jobs? We all have our own point of view. Should creating jobs been his job number one a year ago as opposed to getting to focus on it now? Or was it healthcare? Was it cap and trade? Was it an energy policy? Was it a new policy with regards to spectrum and allocation? But in any event, healthcare costs have been rising. Obviously, it's a problem. We got to deal with it. But Toby Cosgrove at the Cleveland Clinic, and they do a marvelous job out there, and he's very articulate. And he says, what happens with regards to issues about healthcare and basically smoking and the weight of the population? I mean, I like to look at it as the guys have gone up 30 pounds, and that's just not all Heineken's. And then the women have gone up probably 25 pounds over the last umpteen years. And the question is, what does that do for you? But this is what let me go back one. This is what Americans consider exercise. I actually, in light of Tiger, I was wanted to get a golf cart there with a guy driving a golf cart with a dog, but I couldn't do it. So just imagine that's a golf cart and that's a guy doing exercise, or a gal. And there's another example of somebody going to the gym and figuring out. So we have structural challenges beyond that. So the question is this going to work? Is this going to create more pain than it's going to solve? And it's really been, certainly, you got to be impressed with this guy. I mean, basically, he trades everything off to get it passed, gets on an airplane, flies to Afghanistan, comes back the next day, and he's got a bigger spring in his step, and he's telling the other side, now you will follow because I will lead. It's interesting. Any event, from our point of view, you got 32 million new consumers, $950 billion, they're winners, and so on. And then there are some that are going to pay more in taxes. For example, there will be a tax. Right now, if you work in this country and you earn $1, you pay 1.45% for Medicare. If you earn over $200,000, which is probably what you'll get after you get a bonus, a recruiting bonus in your first year base, you start paying an extra 9 basis points, and the employer has to match part of that. So that's going up. And then they're going to put it on passive income. So interest, taxes, dividend, capital gains starting January 1st. Not a problem. I mean, the real problem, we can go over taxes. Let's talk about what we do every day. And here, at this point, you can interrupt me. Because before I didn't know what I was talking about, so I couldn't answer your question. Now I have some semblance of answering your question. POSP has nothing to do with basketball. It's plain old stock picking. The ones I'm going to talk about are these companies and how we focused on them. We tend to be size agnostic. We do own over 5% of probably 120 companies. We went to a meeting today for a company in Indianapolis called Steak and Shake, and they have about 700 steak burgers. And the stock was, they did a reverse split. This guy Baglari, Sardar Baglari, has renamed it. Instead of Steak and Shake, it's called Baglari Holdings. I got to worry about his ego. We're tracking. We own about 9% of the stock. So we constantly go to these meetings. So I'm going to start off with Cadbury. Again, you heard part of the premise. As an analyst, we assign somebody to follow an industry. The industry is called confectionery, chewing gum and chocolate, and candy. So chewing gum, chocolate, and candy, 3 C's, $140 billion industry globally. China, India, starting to consume. So we had the metrics down of what the industry was, and you had Wrigley's as a public company, you had companies like Hershey's as a public company, you had Cadbury, Mars was private, Adams was bought by Cadbury, so we knew the industry. The analyst goes out and eats a lot of chocolate, chews a lot of gum. So we understand and looked at the values. So we have a report, a spreadsheet that we handed out. And so Kevin Dreyer, who I signed him to, and we've given you a shortened version of this, would look at it and create, if some of you have it, a spreadsheet like this. This is the first page of the model. Everybody does models. We do it our way. You gather the data, array it. Arraying it means up in the upper left-hand corner, we look at the market capitalization. We multiply the number of shares by the price. Add the debt, subtract the cash, blah, blah. Get an enterprise value. You then look at each year as a motion picture. What kind of revenues do they get? What are the EBITDAs? What's CapEx to maintain the earnings power of the franchise? How do they grow? How do they allocate cash flow and project out for 4 or 5 years? Some industries you can do it, some are difficult. So we had that roadmap. That's our GPS system. So now we talk about Cadbury. What's the value? Where's the stock? What's the catalyst? So like I always need a break.
Make a formal approach and take the laws. They do now have a drop dead date, so to speak, which is a few weeks hence. Thank you. They're going to do it. The question is, as a Cadbury shareholder, and a fairly large one, what are your expectations, and what do you think is appropriate for Kraft to offer you when you do that?
chocolates are wonderful, but what we did was the following. When we got into Cadbury a couple of years ago, and the reason we bought it was that they were splitting off Dr. Pepper, and Dr. Pepper was an interesting franchise. And then what happened, and what was a major catalyst for us, was when Mars and Wrigley got together, they created a global confectionery, great cash flow business. Irene Rosenfeld at Kraft was ready to do a deal. Like everyone else, she waited till liquidity crisis was over. She got her cost structure in place.
And Kraft is out there raising financing now, which won't be a problem.
No, but forget the deal. Kraft is extraordinarily attractive at $26. Even without this deal, that stock is going to do quite well over the next several years. Independent of that, Cadbury was in disequilibrium. They had to do something to get forward. Now, if you're looking to participate in China and the emerging markets, what I call credit China Russian, not brick, because brick is when in basketball you don't make it. Cribs are when you come out of the emerging countries. Cadbury is a cheap stock on its own. It was a bargain to begin with at 35. Now it's 50. What happened?
Wait a second. Do you like the deal as it's been presented, or do you want more money?
I have no problem taking Kraft stock. The problem is the Europeans that don't take it at Cadbury. I already said.
But you don't know, everybody talks about
I want a kiss from Irene.
You want a kiss. Of course. But you're happy to take more stock, not necessarily changing the mix to more cash.
I don't need more cash, but there'll be a pushback on the stock from the holders of Cadbury that don't want to own Kraft. Notwithstanding that, I don't see how she can't bump it. A kiss is Wall Street language. I mean, I don't know Irene, and I'm sure I'd give her a kiss. But particularly now since we made its money. But it basically was a sweetener on a deal that existed. That's all it meant. It's just, and I don't know how I got into basketball. It must have been the beginning of November, and I had hopes the Knicks would win 4 games for the year or something. So that was Cadbury. Basically, the analysis says it was a pure play confectionery with strong brands globally. They had good distribution in the emerging markets and attractive valuation. So it was in our sweet spot, so to speak, for a chocolate company. The product lines with chocolate, gum, and candy, they had it all. And basically, they had great brands. And we did a report on it. I don't know if it's the one here, but it says this is why we like it. We have a roadmap. We start buying it. We own a fairly significant piece, but not like the guys that were here from Chieftain. Greenberg probably has 5 stocks. We probably, if we're really excited about something, we probably have 4%. We may own the whole company, but we'll only have 4% per client. So we have 4% on $26 billion. That's $1 billion. And so if the company has a market cap of $10 billion, we own 10%. If it has a market cap of $1 billion, we own 100%. And we have no problem owning 100% because if we're right, we can sell the company. But anyway, we've never done that yet, I think. Maybe we got close with Hudson General. And the catalyst number 2 is great brands. I mean, I don't know if any of you have ever had a DDP, a Diet Dr. Pepper, but this is great. We got stock in Diet Dr. Pepper. We bought more, and the stock's done fabulous, and it's going to continue to do well. That's a sidebar. So that was the second catalyst. And then third was that, as you saw on October 5th, and that's the one that really said you got to look at this. And that happened to coincide when Lehman puked it out. Remember, this was not a pleasant time. This is when the reserve fund went bust and commercial paper stopped being issued, and you had to and nobody knew whether the lines of credit, and that was only 15 months ago. That was exciting. But that's the time in which Wrigley and Mars closed, and that was the catalyst, and Buffett put some money up there. So we wrote another report. We said, hey, it's starting to get really cheap, and we started doing the work on Cadbury where they did it. We did more work, and we thought that they would merge with Hershey's. We thought Irene Rosenfeld was a wild card. And sure enough, you multiply the number of shares times the price, you got a market cap, enterprise value. You looked at the private market value of the pieces, we thought it was worth $860, and that's why when she originally put like $730 to $750 on the table, then we wear an arbitrageur's hat and understand the end game. What was she following? She was following a simple playbook of putting what they call a little bear hug on the table, getting everyone to buy stock, putting pressure on the management, and it was fairly simple. And we wound up getting $8.50, and it was taken in paper. We sold as much as we wanted to own Kraft, we sold the Cadbury because we were worried that the pound was getting a little weak and a portion of our return was on the currency. So we sold it in tax-free accounts, and we bought Kraft. So we now have a fairly large position in Kraft. But that's not one that we're going to stay with. It was just mispriced in the market. It's probably owned it a year or two. Another company that we want to talk about tonight is National Fuel and Gas. National Fuel and Gas. How many live in New York City? How many are heated by having a dog in their room or a friend? All right. And how many have gas? If you're in New York City, you have Con Edison that delivers gas. This company does it in a really interesting market called Buffalo. They have 727,000 meters. That means customers. It was founded 100 years ago. About 1934, don't hold me to the years, okay, I'm making this one up. But let's call it 75 years ago. Somebody says, let's vertically integrate. Let's go out and buy land, and we can drill in a Devonian field for gas. We can then find a well, and we can get timber. We could probably have hunting rights, and they probably didn't have acid rain then, so that's probably pretty. And they bought 1 million acres. And they paid like $100 an acre. And they sit on it. And they sit on it. Fast forward, technology occurs. Technology occurs in the drilling business. So before, if you stuck a well down, it cost you $1 million. Now you go and put a well down and you do horizontal drilling, and you have another technology called fracking. You now cost you $2 million, but instead of delivering X dollars of produce, gas, you now get 10x. So all of a sudden this acreage becomes extraordinarily valuable because of a change, a catalyst called technology. And here's the play. This is, where are we? This is the United States. Da-da. And the Barnett Shale field down in Fort Worth. Fayetteville, another big play up in the northwest part of Louisiana. Another one up in the Bakken fields. Another one in the Jonah Field in Wyoming. And then Marcellus, which is the granddaddy of them all. And this is only the last 3 or 4 years. And this is an acreage that plays up from this part of the world. Politically safe, though the governor of the state of is not exactly politically safe. But it's safer than so far the guy in Venezuela or the guy in, some crazy in Iran or whatever. And it also doesn't require us exporting dollars. So it's helpful to our deficit. Third, it's close to market because it gets cold here. And the transportation, that is the pipelines are there. So now we have the right ingredients. So we analyze the company, National Fuel and Gas. They have an exploration and production business. Because when you're in Buffalo, you try to find something in Florida or California, so you get an excuse other than going to the Augusta, which are private planes. They have a pipeline and storage, a utility and energy marketing. And the product that we like is Seneca Resources. Seneca is their name of their E&P exploration and production. Okay, that's the one where they own all this acreage. Now here is a analyst. Seneca is the 4th largest acreage holder, and that's this company here, Seneca Resources. And you look at Atlas, Range, Talisman, XTO. Exxon decided to buy one of these companies. A Japanese company is getting involved, MUFG, I forget which one. It could have been Mitsubishi, and if somebody knows, please jump up. They're putting a deal in. There have been 4 or 5 big plays of partnerships. We expect somebody to come on, if they're not already doing it, knocking on Seneca's door. So you got 80 million shares. The stock could probably, they'll close at $51. So let's call it 52 because that's what they did, and I don't know how to change that. So you go market cap of $4.2 billion, 80 million times 50, 4.2 plus or minus. You've got net debt of $800 million, paying $5 billion. So if we all could chip in, and with Bruce's money, we can buy this company. So if we buy it, how do we make money? What is the value of the gas utility? It's a rate-based business. You're allowed to earn X dollars on your gap. The analysts, and there are hundreds of these old utility guys, they figured out that $18, somebody will buy it. Mark to value. The pipeline. They have a midstream business and a pipeline, and their pipelines gather gas and move it up into the north, south, north, and from Alaska, and that's a very good business. Good cash flow. The proved reserves in The Gulf and in California, we think are worth another $15, and they got some timber. So you basically say, okay, you add that up, you subtract the debt, you're paying the private market value. Ex Marcellus is $40. So what's the Marcellus worth? So that's when we start looking at it. And in this market, land people were going around and going to farm. You're a farmer in western Pennsylvania, and you got troubles. What was that movie, Hillbillies? The Crackets, the Crumpets, the Hillbillies that they found oil in the back. What is it, Clampets? Yeah, that's glad you're here. Basically, you have acreage. Some guy comes up to you, got a farm, $800, just hardly making. He says, "I'll give you $1,000 an acre, and if we find and we drill, $1,000 an acre, 800 acres, that's $800,000. And we drill, you get a royalty, and the state of Pennsylvania says the minimum 12.5%. So everybody says, take it, but now the going rate for that acreage is $12,000. And the royalties are moving up, and they have to drill in 5 years, and this company doesn't have to pay royalties because they own it. And so we have an analyst who actually graduated, Andrea Sharkey, graduated from here last year. So I send her out on a rig. I said, go figure it out. So she goes out and, I don't know if they wear hard hats or whatever. And she's still alive. So we look at the private market value with a catalyst. What would you do if you were running this company? Number one, everybody wants to play. 2, your CapEx is going up sharply. 3, your pipeline business is very attractive because you're the collection system. You're the veins of the Marcellus field and deliver and interconnect with all the other highways. So you call up and say, hey, you guys are buying into this field, let's talk. Do you take a piece of a company, Seneca Public, to create a market value for it so that you can then spin it off down the road and have a company independent of the utility business, which is nice but dull and boring? Or do we set up an MLP for the pipeline, and we add this up and start coming up with, and natural gas today, oil closed today at $86, and you can look at the price for the next 5 years, and you look at the MCF price of gas at $4.50, and they're earning a 35% ROR on the wells at $4.35. Imagine if gas went to $8. So we got a lot of things to play. It's not a pure play, but it's what I like because I've got a fundamental, and we started buying this at 35 or 40, and there's a hedge fund in New York that had bought a piece, put somebody on the board, and we watched what they were doing. That was our interest in getting to focus on this. So that's how we like that kind of analysis. And everyone in this room right now should get in a car, drive to Western Pennsylvania, and go out and figure out who's got a farm, and whether they have a daughter or a son, and if it's 2,000 acres, yeah, it's not so bad. The other alternative is to go back to Qatar and figure out who's got a daughter or son. Anyway, DirecTV. Well, we did, about a year and a half ago, we went to Dubai and Abu Dhabi. We were trying to do something there. Not important what we were trying to do. So we decided to figure out who's this guy that runs this place. And this is the Dubai government with Sheikh Mohammed bin Rashid Al Maktoum. And this was 2 years ago when everything was going well. And we broke this down into various pieces, okay? Figuring out where the banking was, how do we get to Abu Dhabi, how do we get to ADIA, how do we get to Kuwait Investment Authority. And we do this for all these countries because we're trying to figure out who the players are. But why do we do it this way? Well, don't forget, it was helpful for other reasons, because remember we had the problems in Iceland, they went to Latvia, then they went to Dubai, and then they went to Greece. And so by understanding what happens in these dynamics, you can give yourself a roadmap. So we created something. There's a guy in Denver, Colorado by the name of John Malone. Hey, I'll make it bigger. This is the guy that runs a bunch of companies. Don't you tell him I did this. And we said, okay, John, we're making you king, and let's look at your empire. And he owns things like Home Shopping Network. What's that other one that sells stuff? QVC. And he has a bunch of other assets. So we've been following him now for 35 years. And one of the companies that he got involved with was DirecTV. So we've been, the guy's a three-dimensional chess player. He loves investment banking. You put money to work with Henry Kravis, he's probably better. If I give money to Henry or Schwartzman, I got to pay him $2 and $20. I got to lock it up for 10 years. I got to listen to his BS. I can't get out. Here, I got a constant. I listen to his BS, but I can have liquidity, and I'm not giving him $2 and $20. though he's taking a little bit more off the table lately. Anyway, we looked at DirecTV. Again, my map. And what do? Basically, they're satellites. Everyone here watches sports, what's that thing? Football with DirecTV, the sports ticket, what is it called? Sports, whatever. What is it? Jose? Anyway, Sunday football. Anyway, there's 70 million cable households in the United States. Okay, Comcast, Time Warner Cable, Cablevision, Charter, and 3 or 4 control that business. Satellite has 33 million households, and there are 2 players, DirecTV with 19 million and Dish with 14 million. So we do the same thing. We take a look at Dish, 950 million shares. Actually, this is stale. This will be corrected. It's 935 million shares. And Malone had 10 share votes, and he just today in a newspaper, if you read it, he very nicely patted himself on the ass and said, King Malone, you're doing a good job, and here, take a little extra share. So he's taking his B shares, converting them to A, which I don't like, and I said on television today, and he basically is taking a 20% premium, which I thought was overreaching. But anyway, you got 935 million shares, you multiply it at 33.5, $5 billion of dead enterprise value of $38 billion. What do we get for $38 billion? First, you have a person that comes to work every day that tries to figure out how to mark up his portfolio. That I like. Every day. Where is the world going? How do I do it? He created a value by negotiating with Murdoch. He backed into Murdoch's company, News Corp, by buying voting stock, did a swap that basically increased his tax basis, and wound up owning this stock, and now he's buying it in. He just hired a guy from Pepsi-Cola, who was the number 2 guy, Michael White. Michael came on board to run the company. There's 2 big assets in DirecTV, the U.S. and Latin America. Latin America should do about $1 billion EBITDA with minor capex over the next 18 months. We think we can sell that to Telefonica. I was in Madrid last 2 weeks ago talking to Cesar Alierta, who's a member of our board of overseers here at Columbia, and he's got other things he's thinking about. I was trying to figure out whether I can sell him Millicom or buy from him TiVo, whatever, but that's somebody else. For clients. That is worth $10 billion. So basically, if I sell it for 10 and get a tax, I can buy back stock. I have no debt. They do EBITDA of, this thing is probably selling it at 1.5 times, the EBITDA 2 times. Okay, the assets are worth 49 in the U.S., 8 in Latin America. I think that Latin America could be a little more than that. And you knock off the debt, and you're paying $51. The stock has already gone from 20 to 34. Why did Malone do what he did? Why did he convert his B stock where he had voting control to get a premium for himself? And is he making it easier for AT&T to buy because Malone is not liked in Washington, and therefore they would have given him a lot of challenges? Is this a tell? How many of you watch Texas Hold'em? Okay, do you play the cards, or do you play your opponent, or you do both? You've got to look at these tells because we can't get inside information. Galleon is off to the steel warehouse. You can't go and ask for information. You had Boesky take brown bags with cash, and this other guy did other things. We need to have an ability to try to figure out the dots. And we make mistakes, but at least we're thinking all the time of connecting them. And so we're watching what Malone is doing. Is this a tip-off? What does AT&T want to do? What does this 300-page document that Janikowski came out? What does net neutrality mean? What does it mean in terms of this business? Are you going to have downloads? What's speed going to do? And so Catalyst Catalyst 1 was in November when they merged with Liberty Media. Catalyst number 2, we think they'll do something in Latin America. And obviously, you're getting that business. And then the other thing that you're getting was the involvement. Now, another one of those companies that Malone is involved in is Ascent Media. Ascent is a classic. Graham and Dodd, 1934. Buy a stock on the New York Stock Exchange for less than its cash value. Buying cash at a discount and you're getting the business for free. The stock closed today at $28.29. There are 14 million shares, and unfortunately, he has a poison pill in that I'm I like the guy, and it's nothing personal. And I'm asking to remove the poison pill. So you have the stock, 14 million shares, $28, $392 million. You got cash. I must, it's a fraction of a point. It's $375 million. So you're paying $14 million for the business. So when you buy this stock today at $28.29, it's fairly easy. Now, this company was spun off to the shareholders and was born on October 25th of 2008. Nobody cared. All they were caring about at that time was the liquidity and with the blue, what was that guy? Remember that was October, and there was something in Washington with regards to a bailout bill. McCain, that's it. McCain left the campaign, went to Washington and said, we got to have this in the TV stations, and what's that woman's name? Pelosi and that other guy from Nevada. Reed. It's just drama. Anyway, this company was born. Stock was it was sold down to $17, $18 because nobody wanted it. We're just there with a basket. Unfortunately, they have a poison pill, which means that I can only buy 10%, so I bought 10% of the company, and we're asking them to remove the poison pill. I can't believe I'm having such trouble convincing them. Anyway, they have a content business. They have the cash. We think the private market value is $44. This is a business that they transport stuff from point A to point B via digital. It's a very easy business. They're selling it. And so the question is, how are they going to convert this cash into earnings power? How do we get hurt in the interim? What's our risk? What's our margin of safety? What's the catalyst? And so this is how we look at these companies. And basically, the catalyst in our judgment is this guy. He's going to mark up his portfolio. He's going to take that cash, and has he been able to do it? What's his, in quotes, batting average? How successful can he find businesses, capture the mood of the market, and try to create paper value by doing that? And it's been terrific. I would say, like Ted Williams, though, he's probably batting .400, but he's got a high slugging percentage. But it's still the best ever. So in any event, the catalyst is a transaction and a deal. Another one, Millicom. And I'll do this quickly, and please interrupt me.
Well, I think there's
you want me to stop?
Question with DirecTV.
What is questions?
It's Stephen Ham. Is he here?
Stephen, you're canceling your subscription. They asked you, you're stuck. You raised your hand just now. Stephen, he said the question, what was the question, Bruce, that he had?
Well, I'm basically, given the future of programming along through fast internet access, and the DirecTV can't be two-way, do you worry about that, and how does that affect your multiple?
Right. Right now, the stock's selling at 5.5 times EBITDA. Okay, and it's got subscription revenues. People are holding it. They've got exclusively on this sports Sunday package that a lot of people want. I mean, I can't believe it. My cable bill is like $18 a month. One of my guys, Chris Morandi, is like $240. I mean, he's getting internet. He's got 4 daughters. They all watch this. They want that. And he got a phone on it. So I pay a little more. The question is, can they create two-way technology? Will they be able to have an upload? Can they go down to a head-end, distribute? How do they deal in the data world? And that is part of what we're seeing in the spectrum analysis. Think of it a different way, though. If you're AT&T and you're competing against Cablevision, and Cablevision can bundle a sports, video, voice, data, and wireless mobility, do you need a company like this to be part of your bundle that you're offering to consumers, because you can now have a single footprint across the country? And so the question is, can DirecTV do it on its own? It requires some other fixes in technology. But can it do it as part of another company's bundle? So then you look at the market cap of AT&T, you look at how they are approaching it. They're doing something called Uverse or something, or whatever it is, and it doesn't work. Fios, which is the Verizon, has terrific, like 100 megabits of speed, but they're only a small footprint. And so this is immediately U.S. Now, if I were running, or you were running, or anyone was running AT&T, where do they go next? Because they're landlocked. Right now, most of the spectrum that people use is either GSM, CDMA, or TDMA, and basically you're going to a new fourth generation, and that generation is called LTE, long-term evolution, or whatever it is. Totally unimportant to me. But it means that everybody in the world is going to have an ability to compete globally on the same common platform, so that an iPhone or an Android or whatever it is, and all the applications and cloud computing and the apps and the games that you play all coming together. So will AT&T want to put that bundle together? How much will they pay? What kind of form of the currency? Those are the kinds of questions we ask. No different than if you were working in the investment bank at Goldman Sachs trying to do a deal to make a commission. Because you want to make $40 million in the deal. We don't want to do that. We want to anticipate what the investment bankers are going to sell to AT&T, and Malone's going to do it. Because we want to mark up our client portfolios independent of the market. So, Bruce, I don't have an answer, but that's the way we think about it. Stephen, what was your question?
Stephen?
They're putting you on the spot.
Yes.
Thank you. Oh, here you go, Stephen. Thank you. I give you a rotary dollar. Millicom. Millicom, the Stenbeck, there were three families in Stockholm that created a business called Kinnevik, K-I-N-N-E-V-I-K, and I think we have it here somewhere. And we lay out the Kinnevik grid, and they bought land, and they were in Africa, and somehow they got into Spectrum. Fast forward, Tube died. Right now, the last founder died. His daughter is 34 or 5, and she's running the place. And I'm trying to brush up on my Swedish to go there and say hello. But she did go to Georgetown, so that means she probably speaks basketball. So the company's called Millicom. So what do we get in Millicom? First, we go to the wireless world. There's 500 million people that use wireless today. Okay, 500 million? Or is that the right number? Or is it 5 billion? I think it's 5 billion. I know I stated that one. Sorry. Millicom, same type of structure. It trades on the Stockholm Exchange. We started buying it at 100. It's 143. I think it closed there last night. And those are kronas. The estate of Stenbeck, this is where he owns it. We're here, I guess, somewhere. You just make out you see the red line on public shareholders. And so the family controls it, and so what we're looking at is all of their pieces, what they've done. And the one we're looking at is obviously Millicom. So when you buy Kinnevik, you get a double discount. It's no different than you would do an analysis of the family that controls that company in Torino, Fiat. You would break it down, you would do the same analysis, figure out what they own and why. So Millicom is one of the holdings. This company owns 38 million of the 100 million shares. So you obviously mark to market in coming up with the Kinnevik value, then you mark to model. What is Millicom worth? What are these other assets worth on a model basis as opposed to mark to market? And you can do that on Jardine Strategic, which is awfully intriguing. The Jardine, there's a whole bunch of these that you can do it with. Oops, what am I doing here? Oh, sorry. We found that as smart as everyone is in this room, including me, we have to figure out, once you start doing companies like Millicom with all of their holdings around the world, that we have to figure out, if I'm sending someone to Zimbabwe or the DRC or to Mongolia, we have to train them. So we found the video to train everyone. I wish the voice was louder. Can you hear it? Can't get loud. I'm afraid I'm going to just disconnect it if I do it so. Wait till the poor guy gets to Africa. Well, you got the picture, you got the drill anyway. Basically, we found that some people, when we told them they're going to New Delhi, they said, where do we eat? And they thought Indonesia was a new form of malady that their girlfriend had. So we had to correct it. I don't make this up, guys. I'm not that good. Anyway, I said 500 million is 4.6 billion people with wireless phones. That's a lot. And this is where they are, okay? And Millicom is located in these countries in Africa, and you can match that up with the names. I think there were 4 changes since we did that, and nobody picked them up, so I wasn't going to tell you which ones they were anyway. And they have Central America, Latin America, and so on. So now we look at who's moving where. Bharti, in India, announced the deal with a Kuwaiti company that needed cash to buy their African holdings at 9 times EBITDA 4 weeks ago. MTM in South Africa wants to buy Spectrum. Vivendi, which owns a piece of NBC, is selling their NBC, and they just bought a company in Brazil, in the telecom area. You have about 10 companies with market caps in excess of $40 billion, and they're all going to figure out how to come together. What is Vodafone going to do? What is Verizon going to do? What is AT&T? What are the Japanese companies? What are the Chinese companies going to do? And the Chinese have to own Africa. The Indians have to own Africa, and the ones that get there first will have a first mover advantage. So you want to get there ahead of them. That's why we got to go to Zimbabwe. Anyway, that's a different issue. So Millicom. In 2004, that's how many subscribers they had. In 2009, they have that many, and that's where they are. Phenomenal growth. Look at the EBITDA these guys are doing in these parts of the world. How much money can you pay for minutes of cell use in Africa or in Central America or in the South Bronx? Again, 100 million. There's 109 million shares. Stock closed today at, I don't remember the price. It could have been 89 and a quarter. Among friends, 88. 9.6 billion. This is a yummy. This is what everybody. Once Stenbeck, Christina, has figured out what she wants to do. There are no taxes in Sweden if you own over 10% of a company. She can sell this holdings and take it in tax-free and go in and buy Zimbabwe. And that's what they should do. Where do you make money for the next 100 years? New Zealand, Zimbabwe? If you can buy acreage for $50 an acre, where the guy is not going to last forever. Anyway, that's $10 billion. You got a lot of buyers. We figure out the assets are worth by X dollars, and that's only at a 6 multiple and a 7 multiple. I think we could be low. We think you can get a couple extra points. And each point, sorry. So that's how we think about companies. That's how we follow them. That's how we analyze them, and we have fun doing it. And as you know, each of us have our own patron saints. And so Bruce has to pay homage to this guy.
No, I don't.
Oh, come on, Bruce. I know, neither do I.
I have tenure.
You have tenure, I know. So I'm on the board, so he actually, it's reverse. But he's all right. He's done a good job. The school's been very fortunate with Mayor Feldberg and Glenn Hubbard have provided very sound financial leadership and structural leadership. And so, on that note, questions? We can talk about jobs, hedge funds, regulation, starting salaries. We can talk about what Wall Street is going. We can talk about Madison Square Garden that was just spun off. Is it worth it? Are they going to pay for LeBron? Questions?
Yeah, we actually made him submit some in advance.
Oh,
So-
love to hear it.
So Tiago Macera,
Yes. How do you measure the likelihood of the catalyst happening? Because you can analyze the balance sheet, but it's really hard to say the guy's going to die in 1 year or 2, and this impacts a lot. This impacts a lot of timing. And second question: sometimes you are very active in creating the catalyst. You go, you talk, you send letters. Are you at all concerned with reputation and image risks?
I don't have any risks to worry about. Nobody likes me to begin with. No, basically, he's got a lot of very good questions. For example, do you really look at someone who's 85 years old, like some of the Redstone? Well, we owned the company for 20 years called, we owned 30% of it. The CEO was 95 years old.
National President?
No, it's not National President. It's Sequent. Norman Alexander. Norman Alexander lived right here in New York. He lived in Scarsdale. I showed up one night at the Metropolitan Museum. There was a black tie dinner, one of our fundraisers. Here he is on the dance floor at 12:30 at night, pounding away, dancing away. And I'm going home tired. So the question was, what would happen? Unfortunately, something happened. It was the assets were wonderful. Carlyle, the day he died, Jerry Seid then became the acting CEO. The daughter didn't like that, Gail, and she basically had an internal fight. They pushed up somebody else, and bingo. Carlyle paid $175 a share, 75% premium. And they closed the deal in September, October of 2007. I'm riding the train from Rye, where our office is, to Manhattan. And it's snowing, and I got an old hat on and old clothes, and I'm reading a prospectus. This woman jumps in front of me, turns around and says, "Hi, Mario." I said, "Ooh." She said, I didn't know what I could figure. I'm Gail Cunningham. Gail, the daughter of Norman Alexander. Gail Alexander, she had a different name because she was married. And she says, "I'm not pissed off at you for what you did. I have to thank you because we were the last train out of the station." Namely, the deal closed, and everything else then just shut down. So that worked. Some of the Redstone and I are going to be around for 20 more years, but at some point that's going to work. And the assets are good, so we're very patient. We're not going to do anything to accelerate the process. Then the question is, are we active? We, about a year and a half ago, we found that a lot of our smaller companies were doing things in terms of allocating cash flow that we were not extremely comfortable with. So we put an advertisement out that said we're looking for directors. We got a whole bunch, and so we started a suggestion that they add some people for a variety of reasons to their board. And if you're a chummy group, it's like having a skunk at the lawn party. That's how they look at us. So there was a company in Boston called Sonesta. The stock, there's 4 million shares. If you go up to Cambridge, the Sonesta Hotel there, there's 400 rooms. You can analyze it. There's no debt. Cash and debt are equal. The family has been running it forever. There are 14 little Sonestas on the payroll, the Sonnenbergs. I'm not knocking them. I'm just giving you a fact. And we found a few things that we weren't comfortable with.
They're called Sonnenberg.
Sonnenbergs, close enough. And they don't like me either. And so basically, we did the analysis, and the father died, and so on, and we asked for a couple of directors, so we put somebody on. The problem is, and I shouldn't say this, but I will. I have a feeling there's something called the Stockholm Syndrome. I'm not going to explain it. I have a feeling that all of a sudden this guy thinks these guys are smart. And they did not take the smart pills because he joined the board. So there's a disconnect here. So sometimes it doesn't work even if you're an activist and you put things on. Okay? It is what it is. Then we found a company down in Nashville, Tennessee called Gaylord. Gaylord, and some of you remember the coal miner's daughter with the Loretta Lynn and the Grand Ole Opry at the Ryman Auditorium. They have hotels. The management thought they were smart. They bought some dumb deals. They sold them. And some guy out of Dallas was buying stock. He wanted 4 seats. If he bought the stock and he got those 4 seats, I mean, he would have done a creeping control and our clients would not have gotten a takeover. So I said, okay, you want 4 seats? I want 4 seats. And by doing that, we figured they would compromise, and they compromised. So we got 2 seats, and they got 2. So therefore, we checkmated, stalemated them, and the stock is now back up to $31, and it's done quite well. And everybody thinks we're a hero. And we didn't charge the company anything because we paid for that out of our pockets. We don't charge the clients anything. We don't bill it as part of our, what do you call it, the hedge fund fees. We had 11 of these. By the time the last one occurred, it was October of 2008, and we said, no mas, we surrendered. So we didn't go after Myers. And so we filed yesterday a proxy on Myers. And we filed one on Coachman. One in Elkhart, Indiana, and the other one's in Akron. And so we are doing this because we work for our clients. We don't work for the management. We're not against the management. We're for our clients who are shareholders, and therefore we're for shareholders. So we're the good guy. My last name is Gabelli. G stands for good. I'm a good guy.
Mario, that's a good note to end on.
Thank you very much. On that note, summarize private market value with a catalyst. Thank you. Bruce, thanks for having me. Any
Doesn't sell anything. What he does is, whenever he has a consolidated,
Also, when your parents go, I was so
yes, I took the base and I
so is that the question?
it's made everybody crazy, and I cooked on that, so it should be and second thing, I think to do some I thought we should do some sort of stuff, but then not yes, I'm doing some as well. So I expect that I will be done in 2 weeks.
I mean, Enron was the most this guy is done over a long period I guess there is now, what's the about the SUV? There's another side, all of the Can they make trying to teach these guys how to become that was fabulous. It was. The reason I wanted to do that is something when you rush because if you don't worry about right. No, but you say the economic stuff. You ready? Oh. You want to take it out. I want you to do it. Because when you go over, it's really tricky. You shouldn't know.
Yeah, thanks.
Right, but if you're successful, I can say, well, like the fact that Glenn Greenwald said, don't do the models, just do the sorry.
Oh, you didn't?
They're still saying,
oh no, yeah, it's all you know that's right. No, I mean, these guys educate.
Yeah.
I don't mean clients.
Yeah, what's like the principles? Like the head of the stuff. And he tries to
I got trouble. I had the I was a guy who was also as Americans that sold out 40,000. That's it. And we have a speaker that's whole month.
oh, I know.
The goal is trying to get this whole state of the game requirement system. And thank you.
Thanks.
You're sick.
Oh, good.
He's in the line.
Anyway, what I do is add up your subtract this. Then subtract the increase in
And you bring all this stuff back, right? Hey, did you get it right?
Now, that's money they're being honest.
I've got it right, so.
Over 10 years, their earnings are
Yeah, that's fine. I'm going back. Let's go.
earnings problem. People tell you in practice of the long term.
Jose, you're staying in the city, right? Yeah.
See how much they're investing in business in dollars. That number is $2 billion. Something's going on. That number is material. Yeah, we don't know if it's a fraud. Whether they're this is the way it wants. But you're not happy about it. That number looks good.
Yeah.
So there's just 18 cents per dollar of sales. About 6 cents. That's pretty good. You just learned that. That's why you stop everything you want to bomb. Your job, because it's your job is to separate the serious things. That's why temporary buildings. That's why I think there's a difference between being able to deal with numbers and knowing how to look at the numbers. And that's why we're just about trying to do the only thing is that you gotta sit here and do it every month. Yeah, you do. That's why you walk out here. And that's what you just said. Those times 5 pounds. Yeah, no one else is trying to sit here. All right, so you say so the tank versus zero, but then the concept you want. Also, what's up in your table? One is five and a half is that in this house. I mean, look, I think he's, he's really talks about InBev bought Anheuser-Busch for $50. Pepsi sold it to you. Faster built on. Maybe a lot. Power line was just like design.
Yesterday we had this class on security analysis.
Which one?
InBev.
Yeah, but InBev's doing that. You were not happy with the InBev own.
Don't they always say that?
No. Sometimes it will. And why? Because you've got an earnings return that's really solid, like 7%. Otherwise, your market is growing. So you got best without investment requirements for 6%. And you have, Cap says 7, ultimate says going.
It's basically it's like an improvement on the 10,000. I'm going to do one of the two of this.
Okay, that's
good. Figure it assets.
Right. Yeah. Yeah. Okay. You select the name of the exactly. Okay. So look at their perspective. See if you can figure it out. Email. But now let me ask you another very interesting. Do you want to be a business? Exactly the sort of very it's very different. If you like that stuff, if you want to make 19% a year for but you don't want to get it all. You like a lot of those instruments. I'm not interested. No, you're not. No, you think you are. What's the simplest arbitrage? Let's just start with the simplest arbitrage. Closed-end fund. So when we met, the thing we did together was actually there was a fund. There were capital shares in the I'm crazy about the law. Basically, what it was, they sold the capital shares. The income shares get all the dividends. You get the $10 back. Capital shares get all capital gains above the 10. The net asset value of this thing was 60%. Yeah, 3 years to go before it should. And the value stops at 30. So you would get $2 in money out. For $2, you get $6 in the money out.
Yeah,
That's the
planning doing this is busy.
You go through all of them, and just do the entities and see how they
Where do you think?
Okay, so that's where we start. What's the next thing? If you had a fund trading, if you had a German, if you had a Brazil fund, and there's a Brazil fund trading in London, 35% premium, everybody's really excited about Brazil. And there's a Brazil fund trading in Argentina at a 30% discount. So that's a fairly good. What was the next? What do you do with the stacks? In the stacks, you're buying cash. Because you get your share of the cash and you vote no. And very often, if you know the stack has a few-year horizon, you can buy $100 worth of cash 2 years from now for sure for $91. And you can lever up to do this because it's very safe. Because if you vote no, then you get the cash back even if they do the deal. In addition, you get a warrant that you may be able to sell for something more. That's just a straight arbitrage. Now, it used to be something couples if he found a stack that had a 15%, an 85% positive threshold, he would buy 60% of the stack. So if they wanted to do the deal, this was a good deal. They had to drive it. Collect a lot of money. Okay, it's just fine.
Those are fairly simple.
The arbitrage on these deals is very complicated. And they don't realize the cost at all. Now, the reason I'm telling you this is, if you're investing in your time, is it worth your time to figure out strategy? So don't do it. That's what you're interested in. Now, if you really love the game, then what you should be able to do is get the ETF perspective. Because you love the game. Right, but you like doing this, then get the look. Then figure out what's the best process. But I sense that you like that Andy is not the person you want to grow up with. And if that's what I'm right about,
exactly. Everybody, to everybody, exactly. So it's just a style. Totally, some people get worse.
No. 10K so much fun. What can you do? Run, talk to the customers, and look at all these things. Andy does. Andy has these really smart kids who calculate really fast. They'll program computers to figure out stuff.
Okay, good. I'll take it.
That if you do, get the perspective. Because in struggling with it yourself, you figure out
I'm a little worried about it.
Okay.
Drive.
Yeah. I think it might make it yes. So we're doing the accounts.
Work out there. Sprinter on summer, it's like green trees, you drive, you have a little park. Like it's like a different world in New York. Yeah, quick question. Every time you come back, come back to us. If you are, exactly. Yeah, like without appreciating time. Your program value that your cost of capital is higher than your cost of debt. You be valuing it back by pushing it off. The payment going down.
The leverage is a trade-off always between a lower cost of debt and higher risk. Because if you leverage values go up. if you've got a floor below which your debt is going to get pulled. Goes like that, you get sold out, and you don't get the refund.
Say if something, say like a piece of real estate, you're not comfortable with that.
Oh, yes, you do.
What's the floor?
Floor is that you have to review it. And,
You have to refinance because we're not allowed to.
yeah.
Talk about it.
No, commercial loans are 5%. Rents drop.
But the pen.
Will recover later.
You're always taking a risk on the level.
Yes.
But there's no, you just get it from that info. Yeah, you attach it, cost of capital, and cost all contact. The way I cost of capital.
Cost of capital should properly include the expected loss from the risk.
The weighted average cost.
No. The way you do a weighted average cost of capital, you have a cost of equity, which you estimate from God knows what. You have a cost of debt, which is the nominal interest rate. Right? Where in that calculation is the added risk of that?
The risk of the debt is in the
Okay.
Thank you for having me.
Okay. This is the nominal interest rate goes up. Your expected payout doesn't go up. Where is the cost of bankruptcy? You don't pay that to the loan. The cost of bankruptcy is something that just goes up and stuff. So it's not involved there. So where is it involved?
Your actual loss.
Yeah, your actual
loss of capital.
Above what the debt holder recovers.
I was just trying to figure out if you had, if you push your payments out, right? If you have a balloon payment at the, say you're doing real estate.
What you're trying to say is what the formula says is basically that more debt is better. Because if you ignore that risk of failure.
Only if the debt is cheaper than.
Yeah, but the debt is cheaper. Right. The debt is cheaper than the cost.
Always.
Always. Because it's a prior. Look, if I offered you the same expected return on debt and equity that you invested, which would you do?
Debt.
All the time.
Yeah.
So can it possibly be the same expected return?
Yeah.
Security. So it's got to be cheaper. So why shouldn't you do that all the time?
But if you discount back,
you're doing stupid fucking formulas. You have a formula in your head, which is the fraction of debt times the cost of debt plus the fraction of equity times the cost of equity. And that formula says the more debt I do, the better off I am. And that's what you're operating. And that formula is not the reality. And if you think formulas, other than in the complicated arbitrage that Andy Weiss does, you're going to get fucked. Okay?
So but you got to do some kind of model.
Why do you have to do a model?
There's some, you have to have some kind of framework.
Yes, you have to have a framework. Why does it have to be? Do you know enough information to make the model program that you need?
Sometimes you don't.
So why do, but if the model doesn't do that and there is information that's needed. What did we hear last week?
No.
Glenn Greenberg talked about?
No. I came for
Oh, you're an outsider?
I am.
Oh, okay. I'll remember what I said. I'm not going to be able to correct your misguidance. You're going to
You rely on the formula.
Who relied on the formula was like fucking a lot smarter than me.
Well,
You got killed.
that was long-term capital.
Exactly. And I know all this stuff. It's the one job I know exactly. It was my big return on words.
But the formula.
Trust me, they're smarter than you. And the formulas are not enough. They do a lot more about the formulas. And plus, when you do that, there's going to be somebody always on the other side of the tree. And
They understand the formula better than you. So what they do is they sell you the thing with a lot of leverage. You don't want to buy it. Because they're going to take advantage of your naivete all the time.
So there's no, okay, so
You know what the most important fact about this is? Where did you get trained?
where do I get trained? Here?
Oh, you're in Columbia?
Yeah, I graduated last year.
You didn't take any courses. You did?
You never called me.
Like, you just, you did?
I took economics, strategic behavior, and globalization.
But you didn't take this course.
I did. I was in.
Oh, okay. So what's the most important about it?
I think the most important fact, I've been told different things by different people. Everybody has a different answer. I personally think the most important fact is
What is important?
knowing what you want, knowing the information.
That is not a bad answer. The most important thing is the average return of all investments is a matter of the average return of investments. Somebody's going to outperform the market, somebody else is going to.
Like that, right?
Another way of saying that is income loss. Somebody's selling thinking it's going to do that. So when you think about information, what's the way you have to do it?
You have to be on the right side of the
You've
information.
got it. And trust me, if you do the formula business against the guys who are really good at the formula business, you're not going to get the right side.
Sure.
So you would be much better to think about your judgment and simpler models.
I try to do simple models.
Okay.
The problem with the simple model is 9 times out of 10 or more, you can't find any value.
Most of the time.
So then you start getting esoteric and exotic.
No,
you don't
get
get
esoteric and exotic. It's just that there will always be something that's diseased enough. So it's valuable, it's cheap. Disease really is. Where would you look right now if you wanted disease?
healthcare.
Yeah. And where's another place you look?
Globally?
Yeah. Yes, good for you. So how about a healthcare company, Bruce?
But you said in globalization, you actually said yourself, buy what you know,
right.
And if you go to Greece and you play with the guy in
Greece.
Greece,
Okay, there are two things
you're going to lose.
Except that there are certain universal behavioral traits that will create opportunities for you, which is why value is so low. That's what you're taking advantage of. And those traits are everybody loves interest. They overpay for the exciting stuff. Well, and people hate to lose money, so they oversell stuff that's sick. People think they know much more.
So is this going from value to distress? Because now everybody talks about distress.
There are all sorts of non-distressed stocks that people can hedge from stock. I mean, so you got to have just the right way.
Do you have an opinion on
I must give this one guy Jews. No, I don't know what he's selling for now. There might be enough salvage value at 50 cents, but the truth is that the Blockbuster guy came and talked to the retail class 2 years ago. And he got everybody all this thing. And he fits through the project. Guess what? So there's not any continuing value with whether or not the liquidation value is sufficient.
They have.
They can't do that. What advantage do they have in that?
They lost their market share.
Are they good at that? Are they good at the operation? So they're going to enter a business where they're the third best.
But Red Fox doesn't have that much. There's larger scale users, so they have.
What is scale? Wait a minute. What does scale mean?
They switched to that.
No, let's see if this, now you're obviously not our student.
Yeah.
You're an outsider too.
I don't know that.
Oh, for how long?
3 years. He wants to be a student.
Okay. So you'll learn about what economies of scale really are versus what they are. And trust me, the business red box is in, red box is not. Blockbuster. Think about what Blockbuster would have to do.
The fixed cost is spread across so thin that they can't, Blockbuster can't come in and compete.
Because Blockbuster would have to set up those kiosks, let's go to the stores, get them to pull out the red box and set up themselves. And they have to have routes and trucks to service those. Now, they're going to have a big overhead.
For small merch.
And they're going to have 10% of the market share to split that up. And red box is not 90%. Who's got 100%?
And then even if they have deep pockets.
And the only way they can, the only deep pockets done is shit. Everybody can deep pockets too, because that's why they're going to make money lines up with shallow pockets.
See, I know something.
Yeah, you did. You learned. You listen.
So, I mean, clearly the distribution business is dead. I mean,
So what business is left?
Are we just looking at what's the innovations?
Yes, of course. You think it's worth as much alive as dead, given there's nothing it can do well?
They do game their game and their local distribution channel. Their game stock is trading for a little under $2.
The 80 yards straight.
The 80 yards trading for $2.
40 yards.
And it's trading a little bit below its net looking at it.
Yeah.
I just wonder if you.
I don't know, but I think it's a great stock for you. And I think the reason it's a great stock for you is you have more fun looking at graphics. You have looking at this ETF from possible arbitrage. What does that suggest that you do in the future?
Okay. Gravity reminded me of the sin because it's the same thing. You got the business for pennies.
They had the revenues locked in coming out with a new release. The contract.
I don't.
But how do you, if you have, like, that's something on, like, with these stocks, yeah, they have assets, they have cash in the books, but you can't go in there and take the cash. What if they just burn that cash and it goes away in all different.
What you have to ask are these people who piss away money? What's the best test of whether these are people who piss away money? We just talked about it.
Look over a long period of time and see what they're doing with the dividend share buybacks.
Just see where the earnings go. Because you can't keep track.
But look at the history of the company.
For a long period, you look at the trends and see how much they're putatively put into the dollar sales.
Turn that to capital.
And then look at what they say. And then see if you trust them. You got a good problem. Because we bought U.S. mobility $10 a share. We were 6 weeks ago. Because they weren't dying so fast. It was cheap. They're dying, but it was cheap. The price of the selling. And they were putting all the money down. Just started making numbers. I'm not starting a business at all. We got 7 or 9.
So those balance sheet plays, there's a lot of times they're good to have board members have access.
Yeah, you might want to
have it.
So it's gone from $10 to just over 13 in 6 weeks. The question is, since our margin of safety is down, it's not down a lot. These guys start doing crazy stuff, so we're going to shareholders. I'm saying it's a lot of money. You're not good at anything else. You're running a dying business. You're very good sustaining that business. Pump out dividends. Until the last hospital gets rid of the back from Brazil.
Thank you very much.
Okay. Now, you'll remember what I said, right? Because I was so forceful.
I will try to. Hopefully I won't be taken advantage of.
Exactly. Like formulas are killed. Trust me, in the formula world, there are hard boys out there. You need to make it sweet.
He's an engineer.
Ah.
I've been trying to get out of
You see, go into a field where in judging the companies, your engineering background is really helpful.
Well, I have a lot of like IT and cool. I am Oracle, IBM, others. I look at a lot of those companies because I know.
Okay, so we're done.
Yeah, just as far as
Go to the get in touch with Kevin. Get a full list.
No, thank you. That's what you said is
Okay.
This is to take to be able to move number graph and know which number to look at. That's much appreciated.
Okay.
Thank you. Have a nice night.
Yes.
Quickly, I just want to talk to you.
Well, I got a little bit.
Find a program.
For the same.
I mean, the basic. Right.
3 years.
And what was your background?
I'm straight out of undergrad.
Oh, yeah. So you're one of the privileged.
I wouldn't go yet. I started off in our operations group.
Yeah, I used to know research.
And basically,
They're trying.
Mario writes. Basically,
I bought them in 98 and 97, and everything was going electronic. They were like the electronic market makers for that.
Second thing is,
And I bought them, and I did pretty well.
I mean, I know, I'm thinking back then, like their competitors.
so you need that.
There's all kind of, well, existed.
A lot of them got killed. Because there's so many transactions in this document.
GPAs.
And they made their money just like a broker.
Yeah.
So you have to be comfortable with
The GMAT.
So yeah, I basically kind of basically they're sending me for different clients.
It's going to be, I'll see what I can do. I can't do any
Sales and
What I may try and do is, unless you're in a,
Yeah.
so you may get
I'm
it
sorry.
down.
I mean, look,
What I will
for
probably
me, it wasn't what I wanted to do long time. So you do what you can,
is I'll probably try and negotiate which is hard. Which is say your hard issue. That's what you're working with.
But one thing they like me there.
Yeah.
One of the reasons I was just there is it's really
So I will try and negotiate that.
valuable class side.
Yeah.
So just go ahead.
I got it in the started.
Oh, okay. So you're here. Yeah, it's good that you're done. That's
So we did go try and get so much chicken culture.
I guess kind of, I think it's
Says he is pitching out.
Oh, no.
I did a long acquired and short acquired.
Yeah, it's long, the acquirer.
Short the acquired.
Actually,
Yeah,
Long.
but then still make this.
our job is to improve the quality.
Yes, but I got out.
Okay.
You never-
So I asked my boss, I just got this, I said, why is the merchant so true? They offer, the average pitching out, 25 with share trading and so on. He was like, so what? The average buy side, the average sell side stock, target price is 27. I was like, but the average buy side target price is 20, because that's what it's trading. It's like super.
Why would you ever buy clothes?
I think I can do it. There's a guy
Until it closes, you have no risk.
between Meredith and.
Well, you have risk, but you don't have absolute risk.
I mean, it extends where. I mean, my guess is they both probably revalue.
Oh, no, come here and you're looking forward to it. You're not.
So if you're right around the
You're going to take, if you come here and you're
you're going to get some of those.
Yeah.
then you want
everybody does it. Some
People are gonna learn about it.
when you see it all and put it all together, you'll get this approach that seems to be.
That stuff, that kind of stuff I don't do.
Okay, so it's like Mario, they hear it.
Yeah.
Mario is.
It is me.
No.
Yeah.
So, but you'll get
Kind of interesting.
Okay.
I work for venture funding.
Oh, don't say you're interested in that. Because biggest problem is millions of employees included that have more than 80%. You've got more than 90%. And you're still down. So if you say you're interested, it's significant. Basically, it's not food. So, you can get say A. So don't mention. Okay, that's great.
Are you coming to our?
I'm gonna be at the end.
Okay. Awesome.
You're gonna be in Omaha?
No, we're not all allowed to go.
Oh, okay.
It's very select. Group.
I'm guessing Kevin and Chris will be there.
We gotta run.
If they typically go.
You're gonna
There's
do
just analysts that have kind of road shows.
Oh, I see. All right, Steve, unfortunately, I gotta go.
Oh, man. Well, okay, Randall. Thank you. Nice to meet you guys. Thank you. I'll be around. Okay. So, yeah, are you around for? All right. So I'm been back and forth running back now. Legs basically paying me to run up and so it's a little like I'm not hired at school as a sales guy, and I'm not hired from the middle of summer. So it's a shot. It's like an entrepreneurial
Yeah,
shot.
it's
So we'll see.
good for you.
But I'll tell you more.
Okay,
Take care.
see ya.
What number of the series are you guys in for the?
Oh, I think there are 4 more. No, today is Tuesday. Maybe there's 5. No, today is Thursday. Yeah, so there are 5. There are 4 more. The people are still coming. Mario was number 20. Beth Lilly, Lee Lou, Charles Brandis, and so on.
I show up to, if that's okay with you.
Oh, just throw them.
Okay. Maybe sets.
Oh, yeah, no, Seth will be, it's tough because people bid a lot to get in this place. So, there were seats tonight for Mario, but that's not always the case. Seth is almost always around. So, what do you get?
I'm reading a book actually. Bootleg copy.
You should read, he was the editor of the new edition of Security Analysis.
Yeah.
You should read that.
That was going to be my summer project.
Okay.
Because I got my hands on it, and one of the guys at work, said, "Hey, I have it if you want to look at it."
Okay. So email me about this so I remember what I have to do.
Yeah, I mean,